I don't think that anymore you can rely on Social Security and pension plans and that kind of stuff. I feel like you really need to take your destiny into your own hands. And I see huge opportunity doing that through real estate, whether it's actively buying real estate and owning those types of cash flowing properties, fixing and flipping, lending on debt and in funds.
Hey everyone, welcome to another episode of The Adventures of a Real Estate Investor. I'm Susie.
And I'm Michael. We're excited you joined us for this adventure.
So today, Michael and I are super excited. We have Heather Dreves on, and it's just something we haven't chatted about before. I think it's super important to talk about it within this space. And so we are just going to give you something new today, new and juicy.
There we go. Absolutely. Well, now that Susie's teed up nice and well for us, Heather, would you mind sharing with our adventurous family a little bit more about your background and how you got started in real estate?
Well, thanks for having me. And I'm excited to be here as well. A little bit about me. Wow, where do I start? I got into this space 19 years ago, completely by chance. This was not planned. I actually went to school to be a teacher, and my young adult children could attest I would have probably been a horrible teacher. So never even taught, but had a friend in the private money space and was looking for something at that time that was more part-time because our kids were still young. They weren't in school full-time. So he convinced me to come work with him. And honestly, at that time, I knew nothing about it. I thought that when you wanted to buy a piece of real estate, whether it was something you were going to live in or an investment property, you went to your bank. And I thought that when you had money to invest, you called your financial advisor up. That was what I was taught, which isn't uncommon. I think a lot of people grew up that way. And so when I went to work with him, my eyes were just open. I just had no idea. I had no idea that if you had the right deal and the deal made sense and the numbers made sense, that there were private lenders out there that would fund it, that weren't going to put you through the meat grinder that a bank did. Mm-hmm. And I was fascinated and really gravitated more towards the alternative passive investment side of things. I started working with clients that were deploying their capital rather than and putting their money to work for them versus taking this nest egg they'd worked their whole lives to save up to and hoping that it was going to outlive them through retirement. And so I became educated about self-directed IRAs. I didn't even know about that. I was like, what do you mean? You don't have to just put it in traditional stock market. You can buy real estate. And so fast forward 19 years later, and I still work with a lot of those same clients. I'm now an active real estate investor with my husband and my boys, as well as a lender. We fund deals out of our IRAs, and I still get the opportunity. And quite honestly, I feel like it's a privilege to work with clients that I'm helping them create generational wealth and financial freedom for themselves and their families. So that was a really quick explanation, but yeah, that's where I came from and where I am now.
No, thank you so much for that. Because a lot of, depending where you are in the real estate space, right? Like in our corner, all we hear about is how you can use your self-directed IRA or 401k to fund a syndication, to be a limited partner in a grand scheme of a big apartment or a different piece of commercial real estate. I don't know if very many people know that they can also use it as a private money lender. So how are you doing it that way? Can you break it down a little more?
Yeah. And I think one of the other misconceptions also is that people think that you have to be what's called an accredited investor and you have to have a large amount of capital to invest in things like syndications and funds. So just for clarification, we actually have a fund that is open to everybody. So unaccredited investors, you don't have to qualify with $1 million in assets and have high income. And it's actually got a small investment minimum of $1,000. So just on a side note, that is an opportunity. Now, what my husband and I do is he had an old 401k. He had switched employers a couple years ago. We continued to watch his 401k and 401ks are great if your employer's matching it. And if you're still working for that employer, you can't do anything. You have to stay with their plan and plan administrator. But if your employer's matching it, that's like throwing away free money if you're not doing that. That's just silly. But the minute you leave that company, you now have access to those 401k dollars if you're fully vested. And what I don't think people don't understand is you can actually take those accounts, roll them over to a self-directed custodian. So you're not taking a distribution. You're not going to get penalized and taxed on it. But now you're in the driver's seat and you make the decisions where you want to invest in it. And honestly, the sky's the limit. There are some guardrails, and that's what a custodian's going to do for you is they're going to tell you, hey, Heather, you can't invest in this. That's a prohibited transaction. But for us, he was earning 2% on his 401k. And we were like, yay, it's fine. finally positive. It's pretty sad that we were excited about a 2% return. We moved that money over. We set it up with Quest Trust. It doesn't have to be with Quest Trust, but that's who we chose to go with. And now he funded a first lien position note, and he's giving 11% returns on his money, as well as having a first lien against a property that we at least have 30% equity in if we ever had to foreclose. So that's the power in him. Plus his earnings are rolling back into his Roth IRA, which we're not taxed on those investment earning dollars. And when he decides to take that out somewhere down the road, or if we leave it to our kids when we pass away, they don't pay taxes on it because it's a Roth IRA. But there's lots of other things you could do. You could buy an investment property and then your profits flow back into your IRA. So they're pretty powerful.
Yeah, that's really cool. So you mentioned something about a fund, I think, right? Like where people can invest. Like, can you explain that a little bit more? What you meant by that?
Yeah. So we have, I think of investors as two buckets, active and passive, right? And sometimes people do both. I mean, my husband and I do both. And so sometimes it's determined by the dollars you're investing, right? Maybe you're actively buying real estate, but now you're generating all this money. And it's important to take those dollars and get them passively working for you, right? So we have created real estate funds here at Secured Investment Corp. And this is a way that people can invest in something that's backed by residential real estate, but it's a passive way. They don't have to deal with tenants and toilets. They don't have to deal with contractors. They don't have to deal with, okay, I lent these guys money and they didn't pay me and now I got to foreclose on it. So it's really just a way to invest with a bunch of other investors in a pool or a fund per se environment, and we manage it. So we've been managing funds for 11 years. Back in the day, high net worth individuals, like most of the people that qualify to go into a syndication, could invest in this kind of fund. That has changed. About 4 years ago, they changed some of these types of laws. We actually have one that's open to everybody. So this is a way you can put your dollars in, you can earn high yields, anywhere from 8 to 11% historically have been our payouts on it. They're friendly to both IRAs as well as personal funds. And they can create two things for an investor. If you are an investor looking for cash flow, maybe you're retired, you want to supplement Social Security and things like that, but you want your money working for you, you can have your earnings paid out. And then if you're at the age where you're like, hey, I'm still working, I don't need the cash flow, but I want my money working for me, you can actually set your accounts up to do growth mode where you're just reinvesting your earnings. And now you're creating that compounding effect, which is really powerful as well.
That's cool. So when they invest in this fund, what kind of real estate? I know you said residential. What kind of stuff do you typically invest in with the fund?
We are what is considered a debt fund as well as an equity fund, which is not all that common in this space. You guys probably know this.
Yeah.
So what we do is we like our funds to have multiple streams of income. You want to have a lot of different assets in the fund, not just have one asset. That's a big difference between what we do in a syndication. And we want different streams of income. So we take a portion of our fund and we lend that money out. That's what's called debt. So we lend money to real estate investors. So if you guys came to us, Michael and Susie, and said, hey, we found deal in Dayton, Ohio. We want to buy it. We're going to rehab it and we're going to sell it. We hypothetically would lend you money. The fund makes money because you're going to make us interest only payments every month. We get a small, what we call an origination fee up front. So that's the debt component. So there's streams of income that come in from that, interest payments and origination points. The other portion of the fund is what we would consider an acquisition or equity fund. So we buy real estate only in our local markets. So Pacific Northwest, mainly. We will buy residential properties up to 4 units. Sometimes we buy them to sell. We'll buy them, rehab them, and sell them. And then sometimes we buy them to rent them and just create rental cash flow for the fund. But all those streams of income go into what we call the profit pool. And then we just pay that out every single month. Or if people just want it reinvested, we'll reinvest it for them.
Gotcha. So to be clear, is this two separate funds? You have a debt fund and an equity fund, or are they
They're the same.
The same?
Yeah,
okay.
They're the same. So we take 75% of the balance of the fund. We lend that out in debt. The other 25% is in acquisitions of properties.
Gotcha. Okay. And basically what you're saying as well is like you're spreading the risk out as well by lending it, some as debt, some as equity. And then basically what you said is all the profits from all those transactions come back into one pool and then it's split between the percentage of ownership of the fund or something like that, I'm assuming.
Correct.
Cool. Nice.
So right now, a lot of people think that the real estate market is not super exciting. So like, how do you feel about it right now? Or what do you see the future of it being? How has it changed in the past year to 6 months? You can elaborate as you wish.
Well, if you turn the news on, the whole world's coming to an end. That's why I tend to not turn the news on. But for real estate investors like ourselves, me personally, as well as the company, we're excited right now because a lot of things happen in this kind of a turbulent market. It takes a lot of the buyers out of the market, so there's not as much competition. I think that markets are specific, or the market is specific to different locations, right? And I think as a organization like us, you have to be really in tune with the different markets, whether we're lending as well as buying. And that's why we stay in our market to buy. We have better control of that. We see, at least in our market, prices aren't going down. They're not increasing like they were 12 months ago, but they're very steady. Houses are taking longer to sell. In full transparency, they're not selling as quick, and we're not seeing people in bidding wars. But there is a massive shortage, and I think this is across the board, of supply. What has happened is because the rates are so high to refinance or buy a traditional mortgage, they're not seeing people sell their houses that bought 2-3 years ago. They're not upgrading because they have money at 3% and sometimes lower.
Yeah.
They're not going to go buy another house that costs more money and they're paying 7.5% interest rates, right? So we see a big demand for supply. We buy a lot of off-market deals, so we don't buy off the MLS. We're buying out-of-town homeowners, distressed sellers, things of that nature. So I believe that there's opportunity if you're in a good cash position to still buy. What you have to determine is what's your exit. How are you going to exit that property? That's why we're starting to rent a lot of properties right now. So yes, the market is crazy and I wish I had a crystal ball, but mine is broken right now. We don't think rates are coming down anytime soon, but we are seeing people come around and accept it. My 25-year-old son is building his first house and he's paying 7.5. And I'm like, oh my God, that's what rates are right now. What we've told our staff as well as our clients is, yeah, you're paying a higher interest rate, but you're also paying about $100,000 less for that house than you would have 12 months ago. So it's all cyclical. It's a numbers game with real estate, right? Either there's profit to be made there, and if they aren't willing to come down on a purchase price, then you're paying too much for it. So I will tell you, as an operator, I think this is something that all operators need to be mindful of, is to proceed with caution. There's a lot of people just throwing money out there to get their money deployed and probably not in great deals. You don't be so anxious to do a deal just to do a deal. Make sure that the numbers are there. And as a debt fund, we're proceeding with caution. If we're starting to see distressed areas in different markets, like we are very sensitive to different counties, some in Illinois, New Jersey, Philadelphia. There's some pretty distressed areas. We've pulled back, how much we'll lend people money, because I think you need to adjust for that. So we still see opportunity, but we are proceeding with caution. And that's the best advice I could give people, and be willing to pivot. If your strategy was always, hey, all I do is fix and flip and that's how I make money, you might want to look at other strategies, because you can't be so siloed and think that that's always going to work.
Yeah, 100%. So Susie and I focus solely on the multifamily market. And we only have a pulse on that, and commercial side, we don't really have an idea of what's going on the residential side. So this in our listeners as well. And so I would say they're more commercial real estate focused, but some residential as well. But what are you seeing on the fix and flip side of things? Are there still house flippers out there flipping houses today? I know there's still supply and stuff like that. And
yeah, the sophisticated, successful ones are still doing it. Where I think they're having some issues is exiting those loans or finding the deals. Now they got to sell them. And that's what I was alluding to, is we have had some deals where we bought them 12 months ago. Sometimes you buy those types of houses where there's somebody still in it, so it takes you 6 months to get them out of it. You've all seen what has happened in the last 6 months. It's drastically different. So I think that what we have advised our borrowers and our clients as well is have multiple exit strategies. Just because this was your plan 3 months ago, it could be a very different market right now. And so we're seeing some opportunity in the multifamily, and there's a lot of headwind coming up in multifamily. People with adjustable rate mortgages that are, having capital call. And honestly, if you're in that space, there's probably going to be some spoken deals coming up, because there's some very distressed owners right now. But yeah, I think we still see opportunity, but that's probably been the biggest changes. Our borrowers that borrow from us are having some challenges exiting these loans. We have a rental product. We have a 30-year rental loan. So we'll refinance them into that as long as they have a tenant in it and it's cash flowing.
Nice.
And that's why we stay in that residential space, because typically if they're in the affordable housing market space under the FHA cap, they can typically rent those in cash flow and keep servicing the debt.
Yeah. And something that you brought up a little bit was like the multiple exit strategies. Actually, you brought it up twice. And I think that's super important because whereas before, like you could see like cookie cutter deals come out, which is totally fine. We've all been a part of them. But now like you really do have to ask deeper questions when you see a deal. Does it have multiple exit strategies, right? Like what does your rate look like and what is your plan after that? Whereas before it was like this IRR, this cash on cash, 3 to 5 years, whatever. Yeah. And you just had to like the area, really the location or the operator. Whereas now, like you can still like the area and the operator, but like really digging deeper because yes, as operators, right, the three of us, we have our standards and our boundaries and our investment thesis. Everyone who is also a passive investor needs to have their own as well, right? Because something that we don't think is risky, you might, or vice versa. And so it's really important to either learn a little bit more about that so that like what you're getting yourself into.
Yeah. And I think that goes to a presentation I just gave about due diligence on operators. What might be a good fit for you guys to invest in may not be a good fit for me. And I think so many of these investors, they get their dollars moved from, their 401k and they're ready to deploy it. And, they're just anxious to get it out there and they fail to ask the important questions. Like they don't even know sometimes what to ask. And so what I try to tell people is you need to sit down and literally write it out. Like, what are you trying to accomplish? Are you trying to create cash flow? You're trying to create growth and maybe a syndication makes more sense. Do you need tax deductions? What kind of funds are you trying to deploy? Is it personal funds? Is it IRA? Because a lot of times they go into these and you guys probably experience this, calling you, wanting to invest with you, and they have no idea what they're trying to accomplish. And they don't ask the hard questions like, hey, has this operator went through a downturn? Any operator that tells you everything's rosy, we've never had any problems, I would run the other way. I would rather invest my money with an operator that says, yeah, we've been through COVID. We were in it in 2008. This is how we weathered the storm. Real estate is not a scenario every time. And so I think it's asking the hard questions and doing their own due diligence. Like, do they audit their funds? Are they audited outside? Are they auditing them internally? How often are they going to communicate with you? When do you get paid? When does your capital get returned? So I think people need to take more ownership in asking those hard questions. It's nice that people are so trustworthy, but I hear literally horror stories every day. And don't chase yield. That's a big one. If you're chasing yield and something sounds too good to be true, it probably is.
Yeah, I totally agree. I think as this year has progressed, I've seen a lot of sponsors, operators step away because they don't have the knowledge to be able to get deals done in this type of market. And so you see the stronger, more seasoned operators continue to purchase properties and stuff like that. So I'm getting deals done. Yeah. So with that, I'd love to continue talking about these funds and everything like that and the market and operator due diligence. I think we can have an entire podcast
on operator due diligence.
I was actually going to ask you some pointer questions, but I'll leave that for next time. Because we can continue on for the next hour talking about that. But I'd like to move on to our 4 exploratory questions we asked all of our guests, Heather. So if you're ready, we will begin.
Ready.
Cool. So where is one place you wish to travel to and why?
My husband and I are getting ready to plan a trip to Europe, Germany specifically, and some of the other areas in that area. We're big soccer fans, so probably that's one of the reasons is to attend some English Premier games. And then his dad is actually from Germany, so we want to go back and trace some of his ancestors and just explore that. So
that's awesome. That'll be fun.
Yeah.
So then our second question is, what is one thing on your bucket list and how are you leveraging real estate investing to achieve it?
I think on my bucket list is really to teach my kids financial freedom, not to be a slave to a job, have multiple streams of income. I think that is something that is so important. My parents did very well, but they had day-to-day jobs and they were slaves to those jobs. I don't think that anymore you can rely on Social Security and pension plans and that kind of stuff. I feel like you really need to take your destiny into your own hands. And I see huge opportunity doing that through real estate, whether it's actively buying real estate and owning those types of cash flowing properties, fixing and flipping, lending on debt and in funds. I really do strongly believe in the ability to understand that financial freedom as well as generational wealth. I want to just take care of my kids, but I want to set them up in a way that they understand that. And they do. Like they're 23 and 25. I'm already seeing we have them trashing out houses. They have their own LLC. They hated it. They complained the whole time. But now they're like, hey, you got any more of those side deals? I'm like, yeah, that's why. So I just think there's opportunity in it through real estate.
That's really cool.
Yeah, I know. I love that because it's true. Like when you see the ripple of the work that you've done, right? Like so much more happens.
Yeah.
Like, oh, they did listen to us.
Right.
Yeah. So I think we've already hit on this question quite a bit during this episode, but the third question we have for you is, what is one piece of advice you have for someone who starts passively investing in real estate?
I would just say to sit down and write out your goals. What are you trying to accomplish? And you can back into it. If you're trying to accomplish monthly cash flow and the funds you're looking at only pays out quarterly or even yearly, that you're just wasting your time. You're going to have analysis paralysis. So probably just sit down and write your goals out before even starting to talk to operators.
Yeah, that was the exact example I was going to bring up. Like if you want cash flow, if you want to wait until the deal sells, that alone, you will get 50-50.
And some people don't even know. They're like, I don't know. I just was told I should invest in alternative investments. It's like, well, are you working? Are you retired? You don't give financial advice. And I'm sure you guys also take that stance, but it's surprising how little people do know. But there's enough information out there, just like on this podcast, and there's so much educational information out on the internet that people can access it now these days.
Yeah. And then our fourth and final question is, if you had unlimited resources available to you, how would you leave an impact?
I think for me, I come from a family of military. And so I think if I had unlimited resources, the ability to get involved with veterans more and assist fallen soldiers' families, as well as veterans that are displaced. I don't feel like there's enough support out there for them. And they give a big sacrifice for all of us to live the lives that we live and live in the United States. So that would be what I focus on.
No, that one's awesome. Thank you so much.
For sure. So Heather, before we end the show, would you mind sharing with our adventurous family how they can find out more about you?
Sure. You can always visit our website at securedinvestmentcorp.com. There's quite a bit of information on there about our funds that we offer for an alternative investment option, as well as we actually sell notes, which is the debt side of things. Or they can call the office. It's 800-971-5988. It's myself and a small team, so you always can have direct access to me. I'm happy to jump on the phone if you have questions or want to learn more about us.
Yeah, and we'll make sure to have that all in the show notes. So if you didn't write it down, totally okay. It'll be there. Thank you so much, Heather, for joining us. It was a lot of fun to talk about the market. It was a lot of fun to talk about funds and just private investing in general, the debt, the equity side. There was a lot actually that was packed into this. So I really appreciate you being here with us.
Yeah, thank you for having me.
Absolutely. It's an absolute pleasure. So until next time, explore more, adventure awaits.
Woo!